go on Facebook. All right, we're now live on Facebook Live. We're back with a Taxes and Bourbon. Haven't done one of these in a while.
Hey guys, how's it going?
For anybody who's paying attention right now, I'm just troubleshooting a little bit of the Zoom to Facebook functionality. I think we'll be good. I think we're live. It looks like we are. All right, we are live. We are live. Okay. All right, everybody. Thanks for tuning in tonight. This is our first taxes and bourbon in a while. It's been probably about a month or so between the holidays and team meetings and everything that just went on towards year end. Naturally, taxes and bourbon fell by the wayside, but we're back, and I think everybody would be happy to know that this time I'm drinking real bourbon. Look at this. This is from Michael Turner. He's a client of ours, and he sent us he sent me this bottle of bourbon. So thanks, Mike, for the bourbon. Really appreciate it. I'm going to go ahead and take my first swig right now. Let you know how it is.
It's dedication right there.
That's bourbon. That's bourbon. All right.
Yeah, and Tom finally brought bourbon to the table, and it just happened to be when I'd be bringing. I brought some scotch to the party. I was overdue. I needed the good old Macallan. You can't go wrong with the Macallan.
Never tried. I'm gonna have to give that a shot at some point.
Yeah, it's definitely at the top. Might not be from Tennessee, but hey, the Scots got it figured out.
All right. So now that we got the alcohol out of the way, that's the most important part of the entire conversation, of course. Today's topics of the topic of this Facebook Live. I'm not even that much deep into this into the bourbon right now, but the topic of this Facebook Live is going to be buy, borrow, die. So that's a strategy used by the wealthy to continually accumulate assets and take advantage of compound interest, while at the same time being able to use their assets to purchase things that they want to get, like consumer items, Corvettes, things of that nature. So
yeah.
Basically,
or ideally some vacations here and there. Pretty much anything that you could drum up personally.
Exactly. Anything you want to spend your money on, I mean, you could. So the way this strategy works is effectively, there was some controversy that came out late last year in 2021 about how the rich just continue to buy more assets, and their assets appreciate in value over time, and effectively they don't sell it. And instead of selling it and recognizing a capital gains tax, instead they just go and they leverage their assets. So as real estate investors here, for example, you may buy a single family house or multiple single family houses, an apartment building, an office building, so on and so forth. And over time, we know that generally speaking, these types of assets tend to appreciate. And while you could sell it to go and buy something, you could sell a single family home or an apartment complex to go on a vacation or to buy luxury items or whatever really you want to buy. The alternative option is to, as the building or as the asset appreciates, instead of selling it, you can go ahead to the bank and get a loan against that asset and effectively do a cash out refinance or use a HELOC or a line of credit to go and actually purchase those items and keep the asset, allowing it to continue to appreciate over your lifetime and not have to pay any capital gains tax.
Yeah. And I think the big key with that is, getting cash out of your property or your asset, could be securities, doesn't necessarily have to be real estate. But the planning side we're always trying to get in front of is talk to us before you sell, because it's all about, as soon as you sell, that's when you trigger a taxable event. But the key word in that is sale. There's nothing necessarily in there that says bringing on a new form of debt is going to trigger a taxable event.
Exactly. I mean, when it comes to exiting a property, there's usually a reason why people want to exit a property. Just to kind of keep it on the property note for this brief second. Um, People want to exit usually to either trade up into another asset. In that case, a 1031 exchange, or selling and buying and using a cost segregation study may actually make sense as an exit strategy if that's your goal. Other times, people want to sell to liquidate the asset to take its cash and do something else with it. And I think in those instances, when you want to do something else, like buy consumer items, that's when you may consider using a cash out refinance or using leverage. Now, as I said that, it actually crossed my mind that you could do the same thing if you want to go buy another property. Maybe you have a highly appreciated asset that you're not quite ready to sell, or you don't necessarily want to sell, but you have another opportunity, like another property that you may want to acquire. And you can also use that same strategy, buy, borrow, die, with that too. You can just go to the bank and leverage the property, get a loan against it, and take that cash and go use it as a down payment towards the other property. So really the point I'm trying to make here is that when you're thinking about exiting a property, you really have to understand why you want to exit it, what your purpose is, and then go speak to your CPA, go speak to your financial advisor about what options are available to you to exit that property based on your ultimate goal. Because if your goal, like I said, is to if your goal is to simply sell because you want the cash to go use it for something, there may be alternative options besides actually selling the property.
Yeah, exactly. And that why obviously we love real estate, right? And obviously for a lot of obvious benefits. But the depreciation component, I feel like is really key with the strategy too, because we're talking about refinancing, basically pulling cash out, pulling some kind of equity out. This can even be a way for you to kind of renew or recycle, enhancing your depreciation, especially if you've been in the habit of bonus depreciating assets in the first year and building that portfolio. Is that if you are in a cycle where it's okay, it's been 5, 6, 7 years, you've been building your portfolio, but like right now, this is a great kind of time to do it. Not only are interest rates low, but if the market's really tight and you've got concerns about 1031 exchanges, you've been hearing about people that are not able to successfully close, or something that causes their 1031 to fail in time. This particular strategy doesn't constrict you to any specific time window. Obviously, you're going to have a little bit of carrying cost of the interest the longer you're just hanging on to the money, but it gives you that flexibility to deploy it, on whatever kind of asset you need without having to worry specifically, am I reinvesting all the proceeds or whatnot. You can kind of split it up however you need to.
Right. And that's because, thanks to interest tracing, if you go and get, a HELOC, or you go cash out, refinance a property you own, you can, the debt proceeds, the interest will ultimately be taxed and categorized based on how you use the debt proceeds. So you might go use a portion of the debt proceeds to go buy another property, and that interest would be tax deductible in that case, because you're using that for a business purpose to go buy another property. However, if you go and take that money and instead of buying another property, you go and buy a boat for to go drive around during the summer with your friends and your family, then that is not a business. That's a personal. It's a personal expense, and thus that portion of the interest would be categorized as personal interest, and that's not tax deductible. So there is some flexibility in there in how you go about using the money. Great, that's a great point. And
the way I always say it is, it's all about where the money lands. Is what is it going to do when it actually gets to its end point is going to determine whether or not it's deductible.
Right. And you brought up another good point before too, and that's that this doesn't just work on real estate. This can work on a lot of different types of assets, including securities. One of our partners here at the firm actually showed me like this strategy about how you can go ahead and basically get margin loans against a securities portfolio. And while I always realize you can go get margin loans to go buy more stock, that always, I was aware of that, obviously being a financial professional and everything, but I never actually connected the two, that you can go get a margin loan against a portfolio of securities just for whatever you want. It's like it's like basically like a HELOC, but instead of on your house or on a rental property, it's on a securities portfolio. It's a line of credit. So this can work for securities as well, which is awesome. One of the things I was reading that actually sparked this entire conversation about buy, borrow, or die was that people like Elon Musk and Jeff Bezos, they never sell their stock. They won't sell Tesla, and they won't go and sell Amazon stock. They'll let it continually appreciate. Meanwhile, they know that if they want to go and get a loan against their stock, that the bank's going to go lend them the money against the stock, especially in this interest rate environment. Like, why wouldn't you want to consider that option, where people are getting loans as like low as 1% on some types of securities portfolios, which is absolutely insane. So that's what sparked this conversation. I think that's actually what sparked Elon Musk to go and say, you know what, guys, you think that I'm that just hoarding my Tesla stock and not selling it to recognize capital gains tax, I'm going to go ahead and sell it just to prove a point. But that's kind of what the whole entire conversation evolved around.
Yeah, and at the end of the day, it's all just about if you're making an investment and you're placing that money somewhere, as long as your return on that is outpacing the interest that you're paying on the loan, then you're in the black. And it's just ties back to like what another reason why it makes sense for us as real estate investors is I think that's pretty much what we're doing when we are buying and leveraging properties. Is it's all about, yeah, as long as I can use somebody else's money to make me more money, as long as I'm able to cover their end of it, I'm getting to keep all the rest by using somebody else's cash.
Right. I was speaking to a real estate agent recently too. And she was telling me, she's like, what a lot of the wealthy clients I work with, that's what she was telling me. What they do is they'll try to often put down the lowest down payment they possibly can on a property, because they want to keep the cash that they have in places making more money. So why put down, in her view, what she sees is like, why would you go down and put, why would you put 25 or 30% down on a property, in this type of interest rate environment, when you can put the minimum down and then keep that cash moving into an asset that's working harder and making more money. So it's definitely interesting. It's definitely an interesting strategy for sure. It's something that I think I'm going to try to see how I can take advantage of in my own personal finances, but also as I work with clients and try to help them navigate their situation. What is the best exit strategy for them? What is their goals in terms of why they're looking to get the cash, and what assets do they have that they can maybe leverage to get the cash they need, rather than selling and having to recognize a capital gain, which is only just part of the problem, right? Recognizing the capital gain on the sale of an appreciated asset, it's just one part of it, but you also lose that asset now, and that asset you can continually compound. I think me and Justin were talking about earlier today on one of our meetings, that you can let it compound all your life. Then when you die, you're going to get that step up in basis.
Yeah, and that I think that's a critical part of, not just like estate planning, but really, as in real estate, we're always talking about, these kind of 5 to 7 year timelines, but it's also good to consider those like 20 and 25 year timelines, because, when we look at all the historical trends for real estate, it just gets that much more solidified of knowing, okay, sometimes we have a dip here and there in the short term, but over the long term, it always just continues to go up. So not only are you potentially missing out on all that future, nothing's for sure in life, right? But one of the most secure, mindsets to recognize that appreciation is going to be through the real estate. You'll lose that by selling the asset. So this is helping you avoid actually missing out on all that appreciation. But then, as morbid as it sounds, one of the largest tax benefits that you could really capitalize, focus on for your heirs, is getting that step up in basis on all the, not just real estate, but any of the other assets, whether it's stocks and bonds that you're holding, when you pass those to your descendants. So, the fact that that's also helping you avoid depreciation recapture. It's one of the, aside from, I would say, the personal residence exclusion, that's one of the largest, is the largest exclusion that you could really harvest out of all this, and let your kids redepreciate the assets all over again. I love that.
Right. The more and more we talk about this, I'm starting to realize like in order to really buy into this buy, borrow, die strategy, right, you got to have a really long-term mindset. And that's challenging. And I know it's challenging for me for sure. But like every once in a while, I get into that long-term mindset and just always clicks. It always makes sense, right? I mean, look, you look at, say you bought a property in 2006, right? Let's just say, and the value crashed in 2008 along with, the crash. Those property values have mostly rebounded, and probably plus since that point in time. And I would venture to guess that in the next 10, 20, 30, 40 years, that those assets that took a nosedive in 2008 are going to be well in excess appreciated over what they were prior to 2008, right? So the point I'm trying to make is over time, these assets are going to continually appreciate despite, like Justin said, these short-term dips. So if you have the opportunity to keep an asset that that you don't necessarily need to sell for any particular reason, you may want to reconsider. I know we had someone on our podcast maybe a few years ago that said that he regretted, I'm pretty sure we had him on the podcast, I just don't remember who it was, that said they regretted selling any property they ever sold. They wish they held every property they've ever had, because in hindsight, they've appreciated so much that they just regret selling. So there are people out there who will tell you that if you can buy and hold for the long term, you absolutely should. And this is the way, the buy, borrow, die strategy is the way you could still benefit from those those assets appreciation without having to sell.
That's exactly how I feel every time I look back at, where Tesla stock was trading 5 years ago when I was more actively trading. When I have more time to watch the markets and stuff. It's that same thing of like, gosh, yeah, I wish I'd just held on to that. But I mean, we bought a house in 2011, and so market was barely starting to inch out of recovery. And yeah, I mean, now it's worth about twice as much. We had an appraisal done on it for a refinance for this exact reason about 6 months ago. And, so that was, it basically freed us up to buy another rental. So, I mean, it really is it, but that's a good example of like, it's over the span of 9 or 10 years, for something like that to actually work and come to fruition. But it does work. And I'm sitting here, thinking, yeah, I'm really glad that I haven't sold that. And I'm only thinking about what's it going to do over the next 10 years? Is it going to almost double again, hopefully? And I can recycle this process.
Yeah. So, what kind of, unfortunately, this won't work with syndicates, right? So because you generally in the operating agreements of most most real estate syndications, they're not going to allow you to pledge your interest in the syndication for this purpose. It's like usually explicitly in the operating agreement, like you're not allowed to pledge your interest in this partnership for the purposes of a loan. And that's unfortunate because here was my strategy was, let me focus on my core career, right? And I'll just invest passively in real estate, which isn't a bad strategy, through syndicates. But then I'm like, well, over the long term, kind of shooting myself in the foot because you could accumulate, you can accumulate capital within syndicates, but then they're going to sell. You can't do a 1031 exchange on the syndicate with the interest. So you might even incur capital gains taxes. But what's worse is all that appreciation that you're going to that you can get from a syndicate, you can't even leverage against it. So it's a bummer. So I might have to switch my investment strategy, just acquiring large, like just going and acquiring houses or buildings or something just to be able to leverage it over time.
Yeah, so using us as a case study there while Tom's just fretting away about the continued devaluation of cash in his bank account. I'll be refinancing real estate. That way I can invest it in someone's business who's opening up a digital pizza restaurant in the metaverse or something. But just who knows where it's gonna go. But
I was bummed out. I was really bummed out by inflation last year. It just ran away, and you realize you could be frugal financially. You could be sound with your budgeting and have goals, but sitting on too much cash, which is not really part of this conversation, but yeah, I mean, sitting on too much cash can be bad. So you definitely want to get that cash moving and put it somewhere. The question just is, where do you put it? And if you have a long-term horizon, if you have a long-term mindset, you really probably are not going to go wrong putting into real estate. If you buy it right, you buy the right property, um, and you manage it right, I'm sure you're not going to be going wrong over the long haul. And again, that's over the long haul. So
And I'm glad, like, the way that you said it was like sitting on too much cash. And I think most of us are familiar with that, that phrase, that terminology, is, yeah, inflation's kind of eating away at you. And that's why real estate is an excellent hedge against that. It's something tangible, something real, that's appreciating and outpacing inflation. But, that really can be said for sitting on too much equity too.
right.
And that's exactly like what we're driving at, is that you might just be keeping pace with inflation, but as far as like your continued investment growth, if you're sitting on too much equity where you could be, it's almost kind of like looking at what's the opportunity cost of not refinancing and pulling some equity out. And like I said, depending on your risk tolerance, that just depends on whether or not that's your leveraging back up to 70, 75, 80%, whatever you're comfortable with. But that's kind of what you're giving up by, because I know I talked to a lot of investors that are in the more conservative side that'll say, oh, yeah, my goal is to have, say, X number of properties and I have them all paid off by the time I'm 60 or whatnot, which it sounds great like on the surface, but when we start digging into kind of this level, is that you could wind up sitting on too much equity. And it's a little bit more of a kind of another topic, but I wish I forget which book it was that I read brought this up, was because it's stuck with me forever too, is that this kind of side benefit too of having a little bit of debt attached to your property is it doubles a little bit as a mild form of asset protection as well. Because again, if you have a property that's completely paid off and it's not encumbered by any debt, if you were in like some kind of legal situation where somebody was, say, an old tenant was trying to sue you for something to fall on the property, it looks more appetizing to not just the tenant may not know that, but if they retain an attorney that's worth their weight in salt, they might be looking into things like that to see, is there a lien on this property? And if it's completely unencumbered and it's worth $900,000, they may be more inclined to accept that client or take on that lawsuit, just because they know there's a lot of meat on the bone to go after, because there's a lot of equity in that property. Whereas if you had $650,000 mortgage on that $900,000 property, they might look at it and go, by the time we actually get through the suit and we foreclose on the property, we force them to sell it, whatever we have to do, list it with an agent, all that money is going to get chewed away. We're going to sell it below market value. And now a lot of that's gone. So, this can even just kind of double as a mild asset protection strategy. So also minor, just kind of, I would say, opportunity cost of not having some debt there.
No, excellent, excellent point. I actually spoke to, I was actually just, as you were talking about that, the return on equity thing actually just crossed my mind. And I don't know if you ever heard of that book, every 25 financial metrics, I think it's called, and that every investor needs to know about cash flow. And the guy who wrote that book, I think his name is Frank. I can't believe I'm drawing a blank on this book right now. He was on our podcast too. I'm gonna look up the book.
Yeah, I feel like I've heard of that, but I can't remember what his name is either.
Well, I'm gonna look it up and I'm gonna go into my spiel real quick. So I would not be doing him justice if I didn't. All right.
You got to give props where props are due.
100%. 100%. Okay. So it's what every investor needs to know about cash flow and 36 other financial measures. And it's by Frank Gallinelli. And his entire thing is like everybody's, a lot of real estate investors are focused on cash returns, right? But the reality is, once you own the property, you need to start looking at your return on equity, because your cash on cash return might be fine, but eventually what's going to happen is as you have principal pay down and you begin to pay down the actual loan, the principal of the loan, and as well as the property begins to appreciate, your return on equity is actually going to start to decrease. So you might eventually at some point look at your portfolio, if you start using return on equity as a metric, and say, whoa, this property's return on equity is actually decreasing as a result of the appreciation and principal pay down. And that might be an indicator that you may need to go ahead and look at. Perhaps they always talk about selling the property, but as we're talking about here, instead of selling the property, you may want to go look at refinancing or getting a line of credit to actually then use that capital to increase your return on equity, if you look at that specific metric.
Yeah. Yep. Exactly.
But having said all of that, I think we've beat this topic to death. I don't know. Is there anything else you think we should add in here about return on not return on equity, about buy, borrow, die?
No, I don't think so. Yeah, I think we definitely ironed out all the wrinkles.
All right. So anybody who's listening to this, if you have any questions about buy, borrow, or die, we'd love to hear it in the Tax Smart Investor Facebook group. Who knows, might write an article on it at some point, or do another Facebook Live or some kind of podcast, or who knows. If you like the strategy, let us know. We'll be happy to do more on the topic. Thanks for tuning into this episode of Taxes and Bourbon. And next time I'll drink a little bit more bourbon and make this a little bit more exciting. Have a good one.